Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Wednesday, January 7th, 2026. It is 10:03 a.m. Eastern Time as I'm starting the video. And here's what we're going to do in this one. As I mentioned, I wanted to get one out on focused primarily on the equity markets and the market leading stocks. Those are, call them the Mag 7, used to be the FANG plus whatever. So we'll basically look at the top 10 on the NASDAQ 100, and that has to do with the mathematical weighting on those stocks on both the S&P 500 as well as the NASDAQ 100, being that those are market cap weighted indexes. So as I often say, if you can figure out where those top 10 stocks are going in the NASDAQ 100 and S&P 500, you can figure out where the market's going. So we're going to look at those. I'm also going to look at the 11 sectors of the S&P 500 because the top 10 stocks are in the market are primarily tech. They might be in subsectors in your communication, whatever, but they're still tech companies. So we're going to look at the sectors of the market. As I like to say, an index is simply a sum of its parts. We're not going to go over 500 stocks in the S&P 500 or 100 in the Nasdaq 100, but we can look at the 11 sectors that make up the S&P 500. Pay attention to their weightings. That's a big factor you have to look at. Let me dive into the charts. What we're going to do I'm going to do it this way. We're going to look at the two main indexes I watch, the two big large cap indexes, the NASDAQ 100 via QQQ and the S&P 500 via SPY. And I usually start out on the shorter term time frames and walk my way out. I'd like to just do it in reverse today. So what we're looking at here, and if I neglect to mention it, you can see my time frames up here on the left, top left. There's a monthly chart, also says QQQ monthly right there. And then we'll step down to a weekly, daily, and maybe a 60-minute chart. All right, so I've put up a couple indicators down on the bottom here. You can see I have a lot of others parked here. I don't have them all up at any one time. But what I would point out is this yellow line is our secular bull market uptrend line that comes off the, technically it was the November of '08 lows in the NASDAQ and NASDAQ 100. Every other index, small, mid, large, S&P, Wilshire, the whole stock market was March of '09. Either way, so your trend lines are going to come on off that same point there. And that is a very, very, in my opinion, significant trend line. One that will ultimately be broken. No bull or bear market lasts forever. We know that. History has taught us that many times over. And so we're comfortably above it right now. However, we do have the biggest divergence that we've had by far. Last time we have negative divergence on this monthly time frame, you don't get it often, was back here. You had a 26% drop in QQQ right there. And of course, we didn't even have it down there going into the last real bear market. That was that 55% drop in the financial crisis, '07, October of '07 to March of '09. And there's your bear market in the after the dot-com bubble burst, about an 84% drop in the NASDAQ. All right, so you can see along the way, there's been plenty of corrections. Again, semantics, whether you want to call a 38% drop like we had a couple years ago a bear market or just a correction. I consider it a correction really because you stayed above the trend. But again, semantics, whether you want to call it that or not. I think the old 20% definition of bear market is antiquated. All right, and then this more recent 25% drop right here earlier this year. So that's what I could tell you. These divergences are continue to build, multi-year divergences. That's typically what you're going to get on the monthly chart, divergences that last for a while. And then there's a couple other trend indicators to look at. Number one is you can see down here on the PPO. Let me make it a little wider. In a real bear market, again, these are what I consider the only real bear markets in recent history. The 2000 March of 2000s when the March of 2000s when the dot-com bubble burst, and down into those '02 lows right there, followed by a bull market. And again, these are the whole big thing is a secular bull market we've been in. Even with these bear markets, these were cyclical bear markets. And they were painful if you rode them out the wrong way. They were real, but again, they were all part of a larger secular bear market. And I've made this case many times. I'm not going to get off topic on this one, but I've showed you the yield on Treasury bonds, interest rates, pretty much on the 10 and 30-year bond. How this bull market, by absolutely and utterly no mere coincidence, coincides with that bear market in Treasury bonds. Again, you had falling yields over that same time period. And we all know it's economics 101. Falling interest rates is bullish for equities. And I've made the case many times over that I think there's I know the evidence is in the chart, very strong case can be made that secular bear market in interest rates has ended, and we're most likely, only time will tell for certain, but most likely in the early stages of a new secular uptrend or bull market in rates, rising yields, which will have plenty of cyclical bear markets or pullbacks in yields along the way. All right, so that's kind of bigger picture stuff. And down here you can see that in a real bear market, the PPO will cross down below the zero line. Now, if you're waiting for that, you're going to say, okay, you know what? I want to be that second mouse that gets the cheese, not the first one that gets snapped shut in the trap, right? So I'm going to wait till that happens. Well, the thing about that is, by the time it crosses, the bear markets are usually close to being over, or at least halfway through, right? That was probably a good 40-50% drop or close to it before this signaled. So it's not a timing indicator, it just kind of paints the bigger picture of what's going on. Recognize it maybe if you're in there at that time. So we're comfortably above there now. That 36% drop right there tested the limits, but as I often say, this zero line, other than using it for crossovers to help figure out the bigger trend, does a great job of acting as support when you're above it or resistance when you're below it. So that was, and again, that's something we'll look at going forward in the years to come. We'll keep an eye on this once the trend, the primary trend changes. All right, and before then, there's a lot of work to be done. So you can see the market still QQQ. I'll get to SPY in a second. Still not far off all-time highs. And I have that 20-month exponential moving average. That's this dotted blue line, which I've said is if you're going to use one single indicator, or you want to have my favorite long-term, what I call 401k indicator, that is it. I give it a 10 on a scale 1 to 10 for both effectiveness combined with simplicity. There's nothing more simple than saying, okay, if the indexes, both QQQ and SPY, are above it, you want to be long in your 401k, long equities. And if they're below it, you want to be short equities or out of the market. It's a monthly chart, so the only thing that matters is how you close the month. And what that does, it keeps you from triggering on all these whipsaws. That was a whipsaw, but then you had a solid close below there, and it said be short or out of the market that whole time. Otherwise, be long and strong. And you can see all these, even COVID had a never triggered a false sell signal. That was an intra-month big drop, 36% drop in the S&P 500, only to close the month right back above on both of them, back above there and solidly back above it there. So again, absolutely a 10. It's not 100% perfect, but it's probably the best long-term indicator out there. So we'll watch that. Now, again, if you wait until that triggers, yes, as an active trader, you're going to have drawn down quite a bit. It took about until that monthly close was finalized right there. From the highs, it was a 23% drop. Okay, so we'll usually get in short based on the intraday charts, the 60-minute charts of the daily. But I want to let you know that's something I'm very, very much watching. Turn the lines back on, and from a price perspective, you can see we had this uptrend line off the 2022 lows, broken there, and nothing but back testing so far. And so the problem with back testing, you can keep back testing higher and higher every month. I like to see a big impulsive rejection following a back test to give me confidence that this is just a breakdown, a back test followed by a next move down. So those are your levels to watch on the long term. The 20-month exponential moving average, then the yellow primary trend line. If and when both of those trigger, it will give me a high degree of confidence that we're probably in the early stages of a new bear market, whether that's going to be just another cyclical bear market, or quite likely, in my opinion, the beginning of a new secular bear market. And that has different implications, because in that, you're going to have these great, cyclical, drops, cyclical bull market rallies. They're going to be very profitable and powerful to trade. But then you're going to have another leg down. In other words, instead of being over in about 18 months, 2 years, we could be looking at something that goes on for maybe as long as a decade or more, just like Japan did back in their lost decade, which was really 2 lost decades. You could look that one up on Wikipedia, Google Japan's lost decade. You'll learn all about that and the similarities they had to our current market. All right, so that's it. And then this last one, sorry, that's not it. PPO histogram does a great job also of defining trends. If you look here, that's the green and red bars. Basically, it's telling you when these PPO lines make bullish and bearish crossovers. When the PPO signal line, the white line, is above the blue line, the PPO line, then you have a green histogram. When they cross, that's when the green goes to red. And if you look, and I'll note it, it didn't miss a single one. All the big corrections and bear markets, as far back as you want to go. Even there's COVID right there. It got it. It was quick. If you blinked, you missed it because of all the excessive steps the federal government and the Fed and all central banks and all governments took. But again, it's done a really good job. So we're going to look for that. There's where you triggered right there, and it captured the bulk of that. But you're going to get out for different reasons. Again, if you use that, it's just painting the bigger picture. And the takeaway from it is, in my opinion, it doesn't take an expert market technician to look at the slope of the histogram and see where it's going and when it's likely to cross. Every now and then you get a little reprieve where, or that like last gasp of breath right there where it looked like you were going to cross. You had a little blip, and that's this term I'm talking about, terminal lucidity. I'll get to that in a minute. But then again, in almost every instance, you're going to get the crossover and the trend's going to change. And guys, this is simple. These are momentum indicators. That's what the stock market, that's what human psychology, the business cycle, profit earnings, all that good stuff, the economy, the jobs market, they all ebb and flow in cycles, including the momentum in the stock market. They're all very much interrelated. And you can see here, we had a little blip here. And again, that was far from a whipsaw. I told you that was that correction there. And you can see we are sloping down right now. So if we get that crossover, that's something I'll be looking for. Again, you'll see it here with the PPO lines crossing as well. All right, let's step it down. Let me turn back all my lines. While we're on the monthly, let's do it this way. I'll hit on SPY real quickly. SPY, the S&P 500. So you have a recent breakdown of this trend line here. You're still flirting with new highs or close to all-time highs. And the PPO histogram has made that turn. And you can also see it here. The slope of the PPO was rising, and now it's a negative slope, meaning it's turned back down. And so we're just waiting for that crossover. And again, I'm just going to show you those periods here. Box it in where it was red. And take it above. I encourage you to do this on your own, and you can see the market's performance during these periods of bearish PPO crossovers. I even measured them out here for you. All right, so that's that. It's not there yet, but it's on. We're on watch for that. And again, this is longer term implications when that happens. I'm going to step down to the weekly chart. Here's my uptrend line on SPY right now. We've been grinding in this trading range, really going nowhere now for months, flirting with new highs. But again, that seems to be the MO. That's exactly what the market did right here. And then the technicals played out. By that, I mean, you had the negative divergence. I've already covered it many times over. And you can see, I wanted to point out that the histogram also on the weekly works very well. We had a bearish cross here. And we're not going down. We started to a little, but we're not going up either. And that's exactly what happened right here in this period of consolidation. We made a bearish cross. The market stopped going up. Didn't go down for a while until support was broken, until we broke out down below that trading range, and then the big drop came. All right, so again, you can see here these periods of red histograms are typically correlated with periods of corrections or bear markets in the market. And green histogram, when you get the bullish crossovers, that's additional confirmation. Again, and what I like to look for, guys, are what I call big hills. That's a big hill. That's a big hill. When you get in, when you're consolidating, when the market's moving sideways or volatility's low, you're going to get more whipsaws. And again, those they weren't really whipsaws. They caught the corrections, but the bigger trend changes come after big hills. That was a big inverted hill, right? Big negative hill. There's those April 5th lows that we covered all shorts went long on. You had the same thing right here. You had a PPO crossover, and that ended that bear market. And before I move on to QQQ, same thing, big divergence. I'm going to park that histogram out of the way. We've already used it. And the same big negative divergence that you can see. I'm rolling back now in time on the S&P 500. As far as I want to go, I'm just going to circle all the divergent highs. When I say it's a divergent high, again, this is killing me. This software, I've got to reach out to them. It keeps lines on my PPO keep disappearing. But either way, I put them back there. That was a divergent high, 51% drop on the weekly. Divergent high on the weekly, 57% drop. Okay, those were both bear markets. Yes, the S&P fell less than the NASDAQ after the dot-com bubble burst. When the AI bubble pops, I think you're going to see outperformance in the NASDAQ 100 as well on the downside. 57% bear market. Divergent high 15, divergent high 21, divergent high 36, COVID, divergent high 28, I think that is. That was a divergent high. It was a 22% drop. I put question mark because I believe there's more to come. This is just an extension. We still have divergence building here. In fact, again, lines do disappear. I need to have that one. It's all one big divergent high, and it also shows well on the monthly chart as well. All right, so that's kind of the state of everything in an uptrend. But I have the highest degree of confidence these divergences and overbought conditions, excessive sentiment, deterioration, things I'm going to get to more importantly at the end of this video with the market leaders. I think those are going to play out sometime soon here. And sometime soon is relative to the time frame that you're analyzing. I started with monthly charts. I'm now on weekly charts, and divergences and other technical conditions that build on those time frames. They build over years, typically a couple years. They can span a year, 2, 3 years on divergences and other, breadth deterioration. Therefore, the timing, it can take a while for them to play out. But once they do, these aren't quick pullback short trades. You're going to get 5-6%. You're going to capture a much larger trend. All right, so we're going to zoom here on the weekly. Going to get a little tight. The leading index, the one that matters the most. This is a concentrated view of the stocks that drive almost all the growth or the most of the growth in the U.S. economy, and that includes the big tech names: NVIDIA, Apple, Alphabet, Google's parent company, Microsoft, Amazon, Meta, Broadcom, Tesla, and the likes, right? And they are the top components of the S&P as well. They just have a lower weighting. So when we look at the NASDAQ 100, they're very concentrated. Those stocks alone, the top 10, make up well over, I think, half the returns of the index. So it kind of gives us a little bit of a clearer view. It's like looking at binoculars or a microscope to the indexes. That one put in that bearish golfing candle that I highlighted back here on the week of November 7th, which so far is still intact. It's not the be-all, end-all, but the strategy when you get a bearish engulfing, you can short it with a high somewhat above it or right above it, depending how you want to do. And so far, again, the market hasn't gone down. It did start going down. It certainly had a correction. Don't get me wrong. I think that was a double-digit drop. But just like here, it's been going sideways. Just like here, any new high anytime soon, it's exactly what I said back here before it happened. If we get a marginal new high, would be a divergent high and most likely fail, followed by correction. So we had a 26% drop off there. And if you didn't short the failure of it, which I highlighted at the time, you had a golden opportunity when you broke the bottom of the trading range and took out those 200-day moving averages, the blue and red lines, and then that's all she wrote down to there, right? And so for all the reasons covered at the time on the April 6 lows, we covered all shorts, went full long. And now I expect nothing different. History doesn't always repeat, but it often rhymes. However, I don't know. I just coin toss odds whether we're going to pop a new high. I'll tell you the thing about it. Usually when something's so fresh like this, all eyes are watching it. Usually don't see it repeat. So one of two things are likely to happen, in my opinion. The most likely, we don't make a marginal new high. We break down. Again, I've given you levels. I'm going to get to those when we get down to the shorter term charts. The other thing that could happen is maybe we do pop it, and instead of marginal, we have a blow off top type, similar to what silver has been doing lately and things like that. I put low probabilities based on the technicals and other factors, but again, I'm open to it. We'll watch and see what happens. If and when we break the highs, I'll address it at the time. All right, so I'm going to speed this up a little bit, get to my daily chart. We have an active swing trade. There are multiple entries posted. That breakdown, the back test, the secondary trend line breakdown. We hit my first target. I've been saying forever and a day, and I continue to maintain until and unless the October 10th lows on both SPY and QQQ are clearly taken out, the market will not go down. I mean, obviously that makes sense from an aspect that, those were key reaction lows there, but we tested them successfully, and so it's even more important now. So that's 589 on QQQ and on SPY, and I would encourage you to set price alerts. It's the bottom of the recent trading range, comes in around 652.83, somewhere give or take. SPY again has been in this multi-month trading range, not going up, not going down, and any new high is guaranteed to be a marginal, a divergent high. Again, anything that's not marginal, big blow off top, 10 plus 15, 20% gain in the S&P from here, could take out the divergence possibility, but not high probability in my opinion. So the MO, simply when you get in a trading range, recognize it for what it is, and you get to the top, you short it down to the bottom where you cover. I'm trying to get my arrow tool here, bear with me, and then watch, rinse, repeat. So that's typically, and there's a midpoint line that often acts as support resistance. So this would be your first sell signal, this uptrend line right here on SPY. I have a comparable one on QQQ. That's off the late November lows. Then you have a couple things there. You have the 50-day exponential moving average. That's the yellow line. The midpoint, which tends to define its resistance when you're below it, and then support often when you're above it. And it might not be exactly in the midpoint. I always put a line in the middle of these price channels. And notice that that's where you tend to have these little sub-channels, if you will. All right, so a break below there, in my opinion, greatly increases the odds you come to the bottom of the channel. If that happens, this thing's getting long in the tooth. In other words, I think it's ripe for the breaking, and my preference would not be to try to game another bounce off the bottom there, rather to sit tight on shorts and hold out and wait for a break of that level. And then the next steps, take out the 200-day moving averages and the other support levels you see on that chart. QQQ, if we break that, we still have a second target here. That's going to entail the Qs and the S&P 500 coming in and testing their 200-day moving averages again. And I also have, as you guys know and have had for a while, long-term swing/trend targets right here. Final target still about 260.50 on QQQ. From current levels, that would entail the NASDAQ 100 dropping about 58%. But first things first, and that's everything I just said. You got to get through. You got to break support level 1, then support level 2. The odds really start to go up, in my opinion, when we take out this T1 level. Why? Because you'll have taken out the 200 exponential and 200-day simple moving average. You will also have failed. That was a major high right there in the NASDAQ. This is a breakout to new highs. Any drop below T1, in addition to taking out the 200s, will mean this whole breakout failed. And again, vanishing lines. I'm going to put my divergence lines back on here. I really have divergence all the way over, all the way across. All right, let's step it down to one more time frame. Oh no, we're on the daily. I'm sorry, my bad. I don't know these. I meant to show you those. I'd like to see those on the weekly. Those long-term targets. There it is. This is how they look on the weekly. But we're gonna go back to the daily. I had on a different board. Um, One indicator I want to put up is the percentage of stocks trading above their 200-day moving average. I'm going to put this on when we get to the FANGs or the MAG8, whatever you want to call them. We can put it here as well. Okay, I'll revisit this. Okay, I think I'll jump into the leading stocks next, and probably do the indexes at the end because I really wanted to get coverage of the market leaders. But I also wanted to point out that you can see I have here. This is a what we call a symmetrical triangle pattern, or close to being symmetrical. You'd have that same uptrend line on SPY right there on the lows. Break below it, likely to bring us back down again to the T1 level, 589, which is also that, to me, important October 10th low, as well as this reaction low here. And then a break of that, like I said, would bring us down to T2. An upside break, we're testing it now. So as I speak right now, 10:30 a.m. on Wednesday, we're at higher risk or chance of breaking out than breaking down because we're currently testing it, right? That only makes sense. So a pop above there then has the traders are going to look at these reaction highs. If it has each one of these previous reaction highs are taken out, it's going to increase the chance the Qs are going to want to run at that previous all-time high and then give you that marginal new high scenario. So again, if we pop there, I'd say decent odds that you got it. Let's measure it out for you. A marginal new, and I'm just kind of ballpark, about 3% pop or run, possibly, if it just wants to slightly pop that previous high and then reverse. Of course, we could go up 5-6%. Not my preferred scenario. As I like to say, and you guys hear me say this often, resistance is resistance until and unless taken out. So that's all I can tell you right now. We're at resistance, which means the only play right now is to short. And then if you want to go long, you could go long and pull back to the bottom of the triangle. But this guy's ready to pop. We're approaching the apex. This thing's going to pop one way or the other sooner than later. So a downside break, first of all, a rejection off the trend line, then a downside break of the triangle would be your next sell signals on this daily time frame. Then a break of 589 or that recent low. All right. 60-minute chart. It's, guys, it's just sloppy. It's noise. I've covered this. You can swing these divergent highs and lows. This is my favorite go-to swing trading time frame. Right now, you can see we're just bouncing around a very sloppy range. Again, swing traders can wait patiently and go long and short off these divergent highs and lows, especially with sell and buy and sell signals, because divergences aren't sell signals or buy signals. What are our breaks of support, resistance, trend lines, or pullbacks to horizontal support, like right there, etc. SPY, again, as you know, also this one we do have negative divergence. That's why I put decent odds that this breakout to new highs will likely fail soon in the S&P 500 should these divergences play out. That was also previously a divergent high there, and we had a correction. That was also a divergent high before it, you can see right there, and we had a correction. And what happens, from my experience, it's usually the third time's a charm where you get the bigger correction because this divergence has been building for a while now right there. All right, so we'll see. That's the S&P 500. All right, let's dive into the components. Let me cover those. All right, so NVIDIA. NVIDIA is the undisputed poster child of the AI hype, the AI bubble. Real earnings, again, I don't know. There's questions on, shell gaming going on, things like that. The whole circle jerk with money coming in and out of between OpenAI, NVIDIA, and some of the other companies. But either way, NVIDIA has clearly stalled out. It peaked here, put in a big divergent high, i.e. negative divergence. I believe on the weekly, didn't we have a bearish engulfing candle? Yes, we did. Big bearish engulfing candle on the weekly, which so far has proved to be the top. Bearish engulfing candles, just like their counterpart, bullish engulfing candles, often mark significant tops after a prolonged uptrend, and they also mark significant bottoms, the bullish engulfing candles, after a downtrend. So we'll see if that plays out. Go back to the daily here. What I can tell you is we've been moving sideways for the most part for months now, many months. Going back to really July, I have this in this trading range, and this is the magic number, 165.44. I believe will do the trick. We break that, and then you have the 200-day exponential and simple moving averages just below it. And so pretty much any move down through that level, I believe, will start a real correction or the next bear market in NVIDIA. Until then, all I can tell you, it's in a trading range. You can't squeeze water from a rock, blood from a stone. We're at the resistance right now. I have some minor resistance here, about 195.28. Pop above that could open the door for a run at test those new highs, while a rejection below there, again, you want to watch the levels I gave you. Here's a trend line right there, an uptrend line, very similar to what you have on QQQ and SPY, right there. Then you have the price support, 165.44, and the 200-day moving averages. After that, I think NVIDIA is going to fall quite a bit, and I have given you long-term targets on NVIDIA, which are still very much in play. My fourth and final target all the way down here. These are secular bear market targets. So you're going to need those long-term indicators to flip, and some of those sell signals I'm waiting for on the longer-term charts in order to increase the odds you're going to hit those anytime soon. As far as trend indicators, there's a lot of them. The PPO, I have my, usually it's a zero line on a lot of securities and indexes, but I treat every stock, every index different. So I have a line at, was at negative 1.37, a purple line, which is just below the zero line on the PPO. The zero line's that dashed white line there. And this also does a good job of defining bull and bear trends. In other words, when you're below it, which you were right here, and that's you're also below the 200-day moving averages, you're in a bear market, and you want to be short, and you want to short rallies into resistance, like back to the 200-day moving averages. When you're above it, long and strong, again, on this time frame, it's a trend indicator. So that's what I'm watching for. I'm watching for a cross down below that negative 1.27 line, which is, done a good job of delineating the bull and bear trends. Even that one, there was plenty of meat. That was easily a double-digit drop from when you got the crossover. And also this percentage that it's trading. This is a custom indicator that I created. It's not a default in the, I don't believe it is. I have to check. Maybe it is. I don't know if this one has it. I've created these on different charting platforms that didn't have it. Either way, want to see that stock. It does the 200-day moving averages, especially the exponential, does a really good job of defining trends on tech-related stocks. And so right now, those are the things I need to see on NVIDIA. And until and unless NVIDIA dies, like truly dies, the market's not going to die. So there we are. I don't have very strong convictions on the near-term direction because of this sloppy trading range. I can just tell you it's stalling out. And you're going to have the guys and gals that are glass half full optimists saying this is healthy consolidation, the bull market to work off the overbought conditions and excessive bullish sentiment, followed by a breakout and a resumption of the uptrend, or the glass half empty folks that are going to say this thing is in a consolidation range. Once it breaks that range, we're going to go down, take out the 200s, and have a big correction or bear market. So I'll let you decide. But the thing is, just watch the levels. That's why I go over these. And the takeaway here is, as I go through these top components, the more of them that trigger sell signals or buy signals on the flip side, the more likely the index is going to go that way. Again, as I said earlier, an index or a sector is simply a sum of its parts. We don't need to look at all 100 stocks of the NASDAQ 100 or 500 of the S&P. We only need to look at these top ones due to their huge weighting and impact they have on the indexes. Apple. You can see down here, again, let me turn off all the busy stuff up there. I'm going to roll back. We're on a daily chart again. And Apple does very well behaving to the 200s. In other words, when you break the 200s, it's time to get short, and short rallies back. And once you recover the 200s, it's a bull trend. So you can see it's just done a phenomenal job. And Apple is comfortably above the 200s. What I'm doing here is kind of pointing out this is a State of the Union address, if you will, to the market or to these leaders. And however, so we are comfortably above there. Also, keep in mind that when you get very far, there's also a thing that when a stock gets too far away, this is also how I use the percentage above the 200-day moving averages. You get a mean reversion, right? Nothing goes up forever. This is what the stock market, this is what swing trading is all about. If you are a long-term investor with a 20-plus year time horizon, save your money, cancel the membership to the site, put all your money in the stock market. 10 years, I'll tell you what, I wouldn't. Be careful about that. Don't, just because the last, again, we've been in a secular bear market for interest rates. It is my opinion the next 10 years plus will probably vastly see underperformance compared to recent years, possibly even net negative returns over that period. Especially inflation adjusted. But again, we'll cross that bridge when we go to it. But what I'm getting at is when things get too far ahead of themselves, see this green line I put? You get too far above the 200, you get those mean reversions, right? It's simple stuff, right? Boom, boom. And look at this. So my point is, yeah, this will cross. And by the time it crosses, Apple's going to be down probably, it's already down, I think, double digits. Let me get to that in a second here. Let's turn it back on the lines. I'm going to zoom in a little tighter. Apple's an official trade. I gave a short trade to you with a stop based on a weekly close. None of these candles were a Friday close. That was Friday right there, so saved by the bell. And we've remained below there. And just the other day, somebody asked for an update, and I mentioned I was highlighting this level as a key level, 266.78, I believe to be a good support level, and it was taken out yesterday, as I mentioned in the comment section. Also, the 50-day moving average has been taken out. That's the yellow line. Does a good job also of defining near-term trends in Apple, bullish when you're above it and bearish when you're below it. And my comments yesterday to the person that asked about it and inquired about that level, I said yes, 266.78 was taken out. It was taken out with conviction. I like to see on a break of support or a break below a bearish chart pattern, I want to see impulsive selling. I want to see it ideally on above average volume. That's exactly what we had right here. If you look at yesterday's volume bar, it was certainly above average. And that helps to confirm the breakdown, meaning it increases or decreases the chance it's going to fail. And so far, we're building on those losses today. And so my comments yesterday, that sharply increases the odds we're going to hit at least my first target right there, T1. There's the other targets. And the other, you can see here, I have a horizontal line at a negative 0.02. So right about at the zero line. Here, let me borrow a little more real estate here. And this also delineates the trend. Remember, this is a percentage above 200-day moving average. It's not the PO histogram. I'll put up the histogram. The histogram is going to show you what I just did here when those lines cross. But you know what? I'm getting messy with this. Let me just go back to this. All right. Here's what I want to show you. All right. So I always use the last of the two to cross, which is a signal line. That's the 9 EMA, the white line here. Why? Because the blue line is going to give you more whipsaws. It responds faster to the prices. So if you wait until the white line, you can see right there is a perfect example. The blue line crossed, but the white line had a back test and a rejection. Remember, this line, this yellow line here, acts as support in a bull trend. You want to buy pullbacks to it. When you cross over, that's when you went long based on that indicator, or it confirmed a long entry that we would have done. And we were long there. I went hard long on that low right there, back there on Apple. And that confirmed a bull trend. The bear trend was over, that correction, and a new bull trend had started. And then again, according to this one indicator, if you're just going off that, it said remain long and strong throughout this whole period right here. Well, let's look at what prices did above. You captured the biggest trend. Here it said get out in short. Okay, sorry, I had to pause the video there for an interruption. So that's it. It's pretty clear stuff, right? Look, we captured again that indicator. There's other metrics we use to enter and exit trades, but this just paints the picture of the bigger trend. So from this point here, it was long and strong, and we have just now, if you look closely, just now started to cross below my negative 0.2 level, and we're below the zero line. So that is confirmation of a likely trend change, and the deeper that goes, the more likely it is to stick and less likely it is to prove to be a little slight whipsaw. Okay, so there's Apple. And again, well, no, I didn't say, it shouldn't be again because I haven't mentioned this yet. I do in the past. I've covered how I often will almost always sort my, when I'm going through the components of an ETF, a sector, an index, I'll sort those by market cap, which I have here. So when I started out, Nvidia is the largest at 4.6 trillion. Apple's the second largest at 4.0 trillion. Alphabet 3.8. That's that one share class. Then you have to add up the other right here, and so forth and so on. So when I do these, just keep in the back of your mind that the stocks I cover up front have a bigger weighting and impact on the index. So we have Apple clearly on a sell signal. It's an active short, and I just showed you in the last 2 days the evidence that we're going even lower has increased significantly. And again, that is the second largest holding, as well as the S&P 500. Alphabet. This is a very strong, very bullish. This is a percent above the 200. We're in nosebleed territory. This is, I'm going to put a line here. We've never, ever seen this stock, at least on the daily here, going back so far above the 200. The mean reversion is going to be ugly is what I'm telling you, folks. And again, I don't think there's a stock in the history of markets, unless it was taken out, no longer a publicly traded company, bought private, that has a long trading history that's ever gotten too far from its 200 days and not come back. And again, the farther you get, the more pronounced or aggressive the mean reversion is, and you tend to then overshoot the 200s. At best, if it wants to come and visit the 200s, backtest them or retest them, then you're going to have to drop, or Alphabet's going to have to drop to get to the exponential 27%, to get to the simple, again, depending when it does it, about 31%. Okay, so this guy's in nosebleed territory. No sell signals right now. Remember, overbought can and often does become more overbought. This whole percentage above the 200-day moving average is just a way to see how overbought it is, as is the RSI down here at the very bottom. That's another indicator that I don't take the default. A lot of folks just leave the defaults up on the screen. On that, I do have the zero line as the default for what delineates the bull and bear trends in Alphabet. That is, I have it 0.00. But oversold or overbought, the defaults are 70 for overbought and 30 for oversold. But I look at every stock individually, and to me, Alphabet isn't overbought until it hits 80. 80 is the extreme. You can see by my purple line. So if you start shorting or getting out of your longs or getting too bearish when Alphabet hits 70, you're wasting your time, because it just tends to go right on through there. So you have to set your own, every stock has its own parameters or extremes, and you can see the way divergences work in corrections is, again, divergences are a big part of my trading. It's not that initial extreme overbought reading. It hardly ever is. Once in a while it is one and done, but it's most often you hit an extreme overbought or oversold when you have positive divergence reading, and then you hit some other very high but little slightly lesser overbought readings, and that is what we call negative divergence. The indicators making lower highs with prices making higher highs. So this is our first divergent high since right here. The one before that was right here. I'm just going to measure those corrections for you really quick to kind of give you an idea. So the previous divergent high, this stock fell 32%. The one before that on the daily chart, it fell 23%. I'd expect nothing less than a 30% or so drop coming back at least to the 200s at the next correction. Okay, great, Randy. Well, when does that happen? What do I do? Okay, I'll tell you what you do. Well, we already had a sell signal here. This previous highlight break of that small wedge. We had the drop down to the more significant uptrend line right here. This is the one that needs to break at this point in time. So that was a sell signal. We hit a more significant uptrend line, bounced as expected, and once we break this trend line, that's it. Then we need to take out the 50. So these are the levels of set price alerts. Trend line number 1, 50-day moving average, and you can see all my price levels. These are also price targets on the way down for the next correction. So right now, we're waiting for a sell signal with a solid break, especially a daily close. You can short a break if it's big intraday break. The problem is it's not unusual to see a stick save. Only to see there's one yesterday, a little break below the trend line. I had a price alert go off on it, but I didn't act on it because it was slight marginal and we closed back above it. So if you're going to short it intraday, you really want to see a big red move down through there with little chance of recovery. And if you want to be that second mouse that gets the cheese, you can wait for a solid daily close below. Once that happens, I just gave you my minimum pullback targets, which about a 25% drop. And again, guys, please hear me. If Alphabet drops 25%, I can all but promise you the NASDAQ 100 is going down quite a bit with it. Microsoft, let's analyze this chart, kind of messy. The fourth largest component of QQQ recently put in a divergent high right here, as you can see. Last divergent high was right there. If I want to, for kicks and giggles, measure, that was a series of divergent highs culminating in that fourth and final one, about a 27% drop from there. Very profitable to trade short, very profitable to sidestep if you're a perma-bull and you only go long. Very profitable to side, so you probably would have been stopped out. And then there were multiple sell signals after. But look what Microsoft did. Again, these tech stocks, most of them do just a phenomenal job of acting on their 200-day moving averages. Bullish when you're above them, that's the blue and red line. Sometimes, depending on what the market's doing, a certain stock may be cutting through them, struggling with them. But once it's clearly lost, then a bear trend starts. And what you do, and we did, short rallies back to the 200s. And so this whole time you were below the 200s. Here you recovered the 200s, a new bull trend began. Multiple successful months of successful tests of the 200s, but finally it couldn't hold them there. And when it lost them, again, not from the highs, but from when the 200s were lost, the stock fell another 19%. So fast forward to today. Remember, this indicator down here shows you when and how much the stock is above or below its 200s. And just like the PPO that I showed you earlier, you don't have to be an expert technician to see when a trend appears to be changing. Remember, we didn't cross there. We had successful defenses, but this time we did. And if we do it here, we start moving below the 200s. That's going to be increase the odds that Microsoft's going to go a lot lower. So I want to zoom in here real tight and just show you we've been testing the 200s like a world champ. Again, I always say if you have to squint to see if you're above or below them, give it the benefit of the doubt. And again, take all these top 8, 9, 10, take them collectively. Because if 8 out of the 10 are above their 200s and above their trend lines, good luck shorting the NASDAQ 100. It's not going to work. But if the majority break down, especially in close proximity, you need to jump in there because they're going to take the market down with them. All right, due to their big weighting. So that's it. So we have Microsoft at support, but in a precarious position. It's a lot closer to breaking support right now than it is to breaking out to new highs. All right, and those will be your two next big technically significant events. Amazon, you can see here I have a trend line for you right here. Uptrend line that needs to break. We do have a divergent high that was put in. Again, a lot of these stocks in the market have a history of making marginal new highs and then correcting marginal new, but if it's divergent, if you have the divergence, you get the correction, Sometimes you'll put in a divergent low. You can see this one's been a little sloppy through the 200s lately, but again, once they were lost right here, right here, lost, back tested, and nice double-digit drop. That was a pierce through there. If I'm not mistaken, we didn't. I recognize that, but didn't act on it. In fact, I covered all shorts right then there because a lot of other things were hitting support levels. And I believe we were long at that point, if I'm not mistaken. That was back August last year. I'll have to look it up. Either way, there's the 200s. Again, very, very important levels for Amazon. And so you want to set price alerts. You also have a trend line right there, an uptrend line. And you can see I have a little purple support level I think is important. It's about 211.17. So these are all the levels. So right now, again, so far, Apple's the only one. I've gone through the top 5 that has broken down. But Microsoft is sitting right on the 200s, a very important support level. Alphabet's right on that key uptrend line. And let's get to Meta now. Meta has flipped, has broken down. Meta put in a divergent high here. It took out this uptrend line. There was a sell signal. Went here, then right here. I'm going to zoom in a little tighter for you. Took out in one fell swoop on a big earnings-induced gap down. Look at that. You think that's mere coincidence? Look where the gap happened, right below the 200s. So you had 2 days of back testing. When the market saw that it was unable to regain the 200s, it was lights out. The stock fell, not from the highs, but from that point of losing the 200s. I have to move over here to measure parallel to it. The stock fell another 15%. So this is often what happens when these guys clearly lose their 200s. You have a nice swift move. And if you wait a week or two to figure you want to short it, too late. At that point, you ought to be looking for the back test of the 200s. And that's what this one did. Back tested, rejected. Back tested, back test, back test. But it's below them right now. It's back testing from below. To me, that puts this stock on breakdown mode like Apple in a precarious position. So now we have 2 out of the top 6 components on, to me, sell signals. Now, if Meta clearly takes back the 200s, it's hard to argue that. At least that one aspect is anything but bullish. But as of now, it's back testing. And what you'd want to see to help solidify or firm up the bearish case is a rejection. You want to see it start to move away from the 200s. Then that will likely bring this one down. You can also see the 0 line on the PPO, which again does a great job of defining those bigger corrections and bear trends. We're below it, back testing from below, just like we're back testing the 200 days from below. All right, Broadcom strong, well above the 200s. In fact, the last and only time in the last couple of years, it went below the 200s right there. We had a 45% drop from the extreme overbought reading and divergent high. And now we have similar technical conditions, negative divergence. I'll have to zoom in. I know this is a busy board. Bear with me. I have a lot of lines and levels on here. There's a uptrend line, price support in the 200s. So this one really needs to get down all below this area here. And based on the scope of the divergences in the chart, I think it will. But until it does, like I said, it's hard to make a case to be aggressive, very aggressively short or aggressively short at all the equity markets. Tesla you have a nice bearish rising wedge, negative divergence. In fact, this divergence, that was a divergent high. We made pretty much an equal, called a marginal new high. That divergence has been spanning all along. When you see it that big on the daily chart, you can actually go to a weekly chart and it shows very well. Also, big divergence right there. But back to the daily chart. So you have divergence off that point. You also have divergence forming here recently as we went in to test or try to pop that previous high. Negative divergence on the indicators. You can even draw it on the histogram of the 200-day moving average, percent above. There's your uptrend line. So right now, Tesla is testing key support. It's a pretty well-defined uptrend line. This forms a rising wedge pattern, bearish rising wedge. So there's my price alert. If Tesla breaks that, it will join Apple and Apple and Meta on sell signals, and who else? They own Microsoft. Oh no, Microsoft was testing. I'm sorry. So that's it. So this isn't mere coincidence. You have a lot of these guys sitting right on those that haven't broken down. Most, not all, but most of those are within one bad day of breaking down. That doesn't mean I'm saying it's going to happen in one day. It just means one bad day. A bad day is a 3, 4, 5% drop, and any of these guys will clearly have triggered those next sell signals I'm waiting for right there. Until then, markets are going to do what they're going to do. And that lately has been just a back and forth slop and chop. Did I miss any? There's ASML, negative divergence. Palantir. I'm going to rifle through the sectors of the S&P. Let me put the 200-day away. Just because I said I would. Tech is the biggest sector. Last time I updated these was at the beginning of September. This will change over time, not by a whole lot. Tech is and has been for years and remains by far the largest, without a close second, the largest weighted sector in the S&P 500. There are 11 sectors total. Of those 11, this one makes up a third of it. Again, as of September, about 33% weighting. And you can see my trend lines. I just want to point out this is the primary uptrend line right now that we have on XLK. So a break below that level, and again, a break below the key October 10th lows. That will do the trick. And then you have your 200 days. Tech has been lagging. I talked about this yesterday a little bit. Terminal lucidity. It's that phenomenon known as the rally. And coincidentally, they also call it the rally. Or paradoxical lucidity or pre-mortem surge, where a dying person, and this is how I view the market, with severe neurological conditions suddenly experiences a surprise and return of mental clarity. So some of you that might have lost somebody that you cared about or heard the story, I've heard these stories where they have that final moment of lucidity. I think that's what the stock market's having really since that last drop last year. And I say so because of the technical posture and recent underperformance of the market leaders. Again, somebody looking, with the positive attitude, glass half full, can say it's healthy sector rotation into financials and other things. I cannot argue that point. That may be what's happening. I can argue it, but it's a valid point. Okay. And sometimes we do see that. So the sectors that were hot and got a little ahead of themselves will take a breather, while some other ones take the reins. However, in the past, I've seen similar instances where the leaders started dying first, stalling out, then breaking down, where everything else had that kind of breath surge, or again that terminal lucidity moment in the market, or whatever it was. So I'm on the lookout for that. Either way, I go off the charts, and this is what I need to see happen. XLK now needs to take out that uptrend line, and then this 138.13. XLF has taken the reins lately. That's the second largest sector. As of September, it was almost a 14% weighting. So still, less than half. Remember, sector number 2 is still less than half of the weighting of the tech sector. However, it's enough to move the needle in the S&P, not in the NASDAQ, because the NASDAQ has virtually little, if any, financials in there. It just doesn't. They're not in there, hardly at all. And so that doesn't matter. So what I can tell you there, recently made a breakout to new highs. That's this yellow line right here. I want to see it fail this level for the first sell signal, next sell signal. First one was a break of this uptrend line right here. I'll zoom in a little bit. We had a breakdown, back test, followed by what I like to see. The problem with back testing an uptrend line, because it has a positive slope every single day, you back test at a higher level. So when you're shorting a back test, well, you can get underwater pretty quick, or gradually, slowly but steadily. So I like to see that impulsive rejection that usually does the trick and tells me the back testing's over. So next stop, if that's the case, a break of 54.47. Why? Because this whole thing is a breakout to new all-time highs in the financial. There's your previous all-time high. Anything down below there means the breakout has failed. That's a bearish technical event because all those folks that bought the breakout, their stops are set here or somewhere in there. A lot of them are, at least. And then you got the 200 days that were successfully tested here. So you want to see those. So again, bearish event number 1 was right here. Number 2 was today, this rejection. Number 3 will be a break of 54.47. Then I have a minor support level there. Then the 200-day moving averages. And if that happens, now we've had the second largest sector, the one that's really been doing most of the heavy lifting on the S&P, rolling over. Okay. Might be a little too early to call it with a high degree of confidence yet. It's certainly a start, but my confidence goes up once we clearly move back down below 54.47. XLY, consumer discretionary. Remember all those big market leading tech stocks I talked about? Some are categorized in XLK, the tech sector, but others are like, for example, this is consumer discretionary, and then you have Amazon and Tesla in there, along with Home Depot and Nike. Those are your biggest components. That's about 11% weighting. Put in a divergent high with a sell signal right there recently. So we're on a sell signal. Hit my first support / target, 117.66. Bounced as expected. And so if and when we reverse and take that level, that'll be your next sell signal. So I have a price alert set for 117.66. That would take us down to my next target, 114.14, which is going to come in with the 200-day moving averages. And then once those go, so forth and so on. And again, keep in mind, the weighting that it has on the broad market. XLC, communications sector, 4th largest sector in the S&P at a roughly 10.5% weighting last time I checked. This has companies like Meta and Alphabet are in there, along with Verizon and T-Mobile. Meta and Alphabet alone make up, again, back in September, whopping 39% of this sector. So, these mega cap stocks, these trillion plus dollar companies just have a tremendous weighting on both the index and these sectors. All right, all I can tell you is there's a new acronym. I'm gonna, I've always said it out loud, but I'm gonna put it on the charts. ANHADA. Any new high. Any new high will be another divergent high. So if we go up a little bit, doesn't guarantee anything, but it, in my opinion, makes the odds very high that breakout, that new high will fail because of the big negative. You can see I have a little space here on my divergence lines. So now this one may have done the trick and prove to be the top, or if we go up a little bit in reverse, we're going to still have, because these indicators are lagging, you're still going to have divergence. Now, we have a blow off top, 10, 15, 20% above there. You're going to take these divergences out. It's not my preferred scenario. This is with an alternative scenario of a marginal new high, and they're one and the same pretty much, because you're talking, 2, 3, 4% probably before a reversal. All right, healthcare right here. Well, yesterday when I started marking this chart up, we weren't there yet. Now we have it. So any new high would be another divergent high. I take out any new high would be another, and we have now a divergent high. Again, I'm going to say it. I repeat these things over and over. Divergence is not a sell signal. It's a condition. It's a condition that is often followed by a trend reversal, or in this case, a correction. But we can certainly go higher, extend that divergence for some time, unless this line is no longer parallel or a negative slope. In other words, until we take out that previous high. So let's see if this breakout sticks. I can also tell you we're pretty much testing the previous highs right now, all-time highs in the healthcare sector. 1, 2, we popped through it today, but we're back down there right now. So a rejection here would be bearish. Probably draw an uptrend line off the lows, give or take, something like that. I don't want to force it. I'm just going to rifle through the rest because they don't move the needle as much. We start getting down now below 10% weightings as XLI industrials. Big divergence, negative divergence. Again, a breakout that's probably going to fail, just like this one did. No different. I mean, we have identical technical postures. Come on, this is, the divergence, the scope and duration of those divergences are about equal. Well, that's not my line tool. I'll use this arrow tool. Divergent high, bear market. divergent high, most likely coming up as a bear market with the 200 days right here. XLP doesn't move the needle. Consumer staples 5%. This one's already rolled over. This is a sector I gave you some trade ideas on. I think it was yesterday or the day before. A sector that will most likely outperform. I can tell you, almost certainly tell you, should outperform the broad market, especially the tech sector, when the next real correction or bear market comes. These are defensive issue things, staples, things that, unlike consumer discretionary, which are things you want, these are things you need. Toilet paper, toothpaste, and the likes. Boring stuff, but not so boring in a bear market when fund managers and individuals are trying to flee high growth tech stocks because the business cycle has turned and they want steady eddy things that are going to continue to sell during an economic contraction. Energy, been going nowhere for years. The energy sector, XLE, it's at the top of that range. Unfortunately, it has negative divergence. It's probably going to play out. So any new high will probably fail. But there's my chart. If it breaks this trend line here, it's probably going to correct back to this level and then this level. This is a trading range. It's TA 101. You recognize that. You sell the top of the range and you go long or cover your shorts on the bottom of the range, right? Simple stuff. And you have a midpoint of the range, which tends to also act as support when above it and then resistance when below it. Okay, long video. I think I got everything in there I wanted to. There's probably a thing or two I missed, and if so, I'll just put that in the comment section down below. Let me get this video out to you guys. I'm going to be out this afternoon. Appointments, got a busy schedule today, some things off-site. So I'll get back to any questions that I don't answer before I leave. I'll get back to you probably tomorrow on those. This has been Randy Finney with Right Side of the Chart. Have a great day.